think silver has potential to pop to about 140. That would be the next upside target. Silver, I'm still pretty bearish on it. There's a lot of damage done to this chart. It's got this massive red bar. These are kind of inside days. We are seeing selling with silver today. We saw a lot of fear in the markets early on, and silver was trading higher, but it's quickly gotten sold into. Silver, I think, could sell off and pull back very sharply. I would temporarily still avoid silver. So I think gold has quite a bit of risk up at resistance. And because we just had peak news and we're at peak price, I think there's more potential for it to pull back at this point. Gold is because it breaks free of the stock market, and gold can provide very exceptional high probability trades. It can provide great returns, and you don't have the downside risk or that third dimension of like, are gold miners going to move up if the stock market falls? Yeah. And so you got to be very cautious of the volatility. It's looking good right up until it doesn't. And you wake up one morning and suddenly you've just like, how did I wipe out a whole month's worth of gains? And so miners carry that risk. Take a look at gold. If we look at gold's chart, it's had a series of moves that are kind of been repeating themselves. We have a rally up and then it consolidates for a while. We have another big rally. It consolidates for a while. We've had this over and over, and usually each time it's around a 20% move. And we've just had another one. And so the big question is, how is gold going to react? A lot of times it takes several months to work through. Usually price comes up and tests near the highs a few times, and then eventually it has a breakout. And so we're kind of back up testing these highs, and we're starting to see, I feel like it's a little exhausted, and gold may pull back and it might build a launch pad to start to break through again. And if it does show signs of a breakout, then it could be very good trade, because the next move for gold based on Fibonacci is telling us around 6,100. So there's some pretty good upside for gold still. But there's a lot of damage done to this chart. And when we look at the chart of gold, this big red bar is something to be worried of. This is a very bearish kind of chart pattern.
A market that keeps repeating 20% surges isn't momentum, it's rhythm, and rhythm can break. As Chris Vermeulen points out here, gold has been cycling through rallies and consolidations, but that large bearish red bar suggests institutional distribution may be hiding beneath the surface. Fibonacci targets near $6,100 sound attractive, yet exhaustion at resistance often precedes multi-month digestion phases, especially when sentiment is elevated. For portfolio managers, this isn't about upside fantasy. It's about whether risk-reward still favors new entries after a vertical run. Next, Chris Vermeulen discusses whether this consolidation becomes a true launchpad or a deeper reset.
The body of this red bar, we have all of these bars inside acting as inside bars. This is a bearish price action, and it can mean that once you reach and breach that level, you can have a very big red bar that brings it right back down. And we saw this in silver back in 2011, actually. If we look at the silver chart down at the bottom, we had this huge red bar, and then you have all these inside bars. It works itself back up, and then it breaks and resolves to the downside. So that's like a visual of kind of how that can play out. And so that's kind of what we're trying to figure out with gold. It's either it needs to put in more time and build more of a launch pad and prove that it's not just going to get rejected here. But I do like gold. If gold builds a nice launch pad and takes some time to recover, hopefully we don't have like more war stuff that just creates it to pop and take off, because I feel like getting up into this range at any point, I think we could actually see another big bout of selling. And if for some reason something in the Middle East seems to kind of get somewhat resolved, or bombs stop getting dropped and things like that, we could very quickly just naturally see the fear dissipate and gold pull back very quickly.
Inside bars after a massive red candle aren't calm. They're compression before a decision. As Chris Vermeulen points out here, this pattern mirrors silver's 2011 top, when a dramatic spike resolved into a sharp downside break once support failed. Markets often disguise distribution as consolidation, especially when geopolitical headlines keep fear elevated. If tensions ease even slightly, safe haven flows can reverse faster than retail expects, leaving late buyers exposed. Investors should remember that news-driven premiums rarely hold without structural demand. Next, Chris Vermeulen unravels whether gold is building strength, or quietly setting up for rejection.
So I think gold has quite a bit of risk up at resistance. And because we just had peak news and we're at peak price, I think there's more potential for it to pull back at this point. But over time, I do still like gold if it can build a bull flag and then eventually have a nice breakout.
How are you bullish on silver right now? Let's talk about silver real quick.
Sure. Silver, I'm still pretty bearish on it. There's a lot of damage done to this chart. It's got this massive red bar. These are kind of inside days. We are seeing selling with silver today. We saw a lot of fear in the markets early on, and silver was trading higher, but it's quickly gotten sold into. So I'm not a big fan of silver at this point. I definitely prefer gold because it's more stable, but it also has a much stronger price pattern. And investors go to gold when there's actually, some real fear going on in terms of war and things like that. And that's the scenario we're in. So silver, I think, could sell off and pull back very sharply. I would temporarily still avoid silver.
Peak headlines and peak price often arrive together, and that's rarely coincidence. As Chris Vermeulen points out here, gold is pressing resistance, while silver shows structural damage and failed intraday strength, classic signs of fragile momentum. Silver's quick reversal after early fear-driven buying suggests weak hands dominate, not steady institutional accumulation. Historically, silver amplifies both upside and downside, which means in unstable macro phases, it can underperform gold dramatically. For diversified investors, stability sometimes matters more than talk. Next, Chris Vermeulen talks about when silver might actually earn back its bullish case.
It might be a very good play when gold builds a launch pad. We'll take a look at silver. We'll see how it looks. And it could be a very good play. I think silver has potential to pop to about 140. That would be the next upside target based on technical patterns. So there is potential, but I definitely want to wait for silver to prove that it's built a base, that it is starting to go up, and then I'll jump on that train.
Okay. Chris, let's wrap up now with gold miner stocks. Just take a look at the GDX.
Sure. Yeah. When we take a look at this, the miners have definitely they've already pushed to some highs. They've definitely been leading the way with gold, and there's been a huge talk, in the precious metal space of, gold and silver having, or especially silver having, just so much value added to it so quickly. A lot of people have been, moving from physical and moving into miners. And I think there's been a huge tsunami of investors doing that. And so that's why one of the reasons why I think gold miners have done so well, and silver miners as well, because money's come out of physical silver and it's moving into the miners.
When miners lead the metal, it signals speculation is accelerating faster than fundamentals. As Chris Vermeulen points out here, capital rotation from physical silver into mining stocks suggests investors are chasing leverage, not safety. Targets like $140 in silver sound compelling, but without a confirmed base, upside projections remain theoretical. The surge in GDX reflects liquidity flows and equity appetite, which also ties miners to broader stock market risk. For portfolio builders, that correlation matters more than headline gains. Next, Chris Vermeulen discusses whether miners can sustain leadership if broader equities weaken.
And so there's a money flow. And I think that's probably why silver is underperforming, is because people aren't looking to jump into it. I think a lot of people are buying get into the miners, and because the multiples, aren't quite there. Depending how you look at the fundamentals, we should see miners like way, way higher. But so that's what I think's going on. The fact that we've seen gold stocks and miner stocks, they've pushed to new highs. I think that's a good sign overall, but there's definitely a movement away from physical silver and into miners. And I think that's why we're seeing miners push to all-time highs and silver has stagnated. So again, when gold has a bullish chart pattern and when I believe it's breaking out for real and not just based on some type of news, I want to look at miners as well. Typically, gold, silver, and miners, they are the same play. You can generally hop on any of them at the same time and they should move. It's just which one has the best potential for gains with the least amount of downside risk. And that's just the way I look.
the miners, they're stocks at the end of the day. So if you're, let's say if you're bearish on the stock market, but still bullish on gold, where do you sit?
Wall Street calls it rotation, but underneath it looks more like leverage chasing leverage. As Chris Vermeulen points out here, money is flowing out of physical silver and into miners, pushing equities to new highs while the metal itself stalls. That divergence matters because miners trade on earnings, multiples, cost structures, and equity sentiment, not just bullion prices. When investors crowd into miners for torque, they also inherit stock market risk, especially with indices near record levels and valuations stretched. Next, Chris Vermeulen unravels what happens to miners if broader equities finally roll over.
Yeah. So if the stock market, based on our strategy, our asset reinvesting strategy, has the stock market in a downtrend saying don't hold stocks, generally we're not going to hold stocks, and we're not going to touch miners simply because they are a stock stuck in the stock market. And if the tide is going down and stocks are falling, miners are going to have this headwind to battle to keep moving up. So that's one reason why I really like gold. Is because it breaks free of the stock market, and gold can provide very exceptional high probability trades. It can provide great returns, and you don't have the downside risk or that third dimension of like, are gold miners going to move up if the stock market falls? In a lot of cases they do, but not very much. And it could take 2 or 3 weeks to move up in price like we've had right now, and then one day it all gets wiped out. And that's the problem with the way the stock markets and things move, is the markets fall 4 to 7 times faster than they rise.
Correlation risk is what quietly destroys portfolios when trends reverse. As Chris Vermeulen points out here, miners are still stocks, and if the broader market shifts into a downtrend, they face a structural headwind no matter how strong gold looks. Historically, equity drawdowns unfold 4 to 7 times faster than advances, which means weeks of gains can vanish in a single risk-off session. For long-term investors, that speed asymmetry changes position sizing and exposure decisions dramatically. Physical gold may decouple, but miners rarely do for long. Next, Chris Vermeulen talks about how volatility reshapes risk management in real time.
Yeah. And so you got to be very cautious of the volatility, because it's looking good right up until it doesn't, and you wake up one morning and suddenly you've just like, how did I wipe out a whole month's worth of gains? And so
fair enough.
Miners carry that risk.
Oil is the biggest mover. Can we take a look at the oil price first?
Yeah, sure. Yeah.
We were expecting oil to move on the Strait of Hormuz closing, and it was interesting how it didn't really move on Friday afternoon, Friday night, given that, futures are traded around the clock. But I'm going to get your take, because it just moved last night, and it was a big move.
Yeah, well, there's definitely, the markets have been really kind of chattering and trying to figure out what to do. The equities market, precious metals, oil has been moving higher for the last several weeks and trying to figure out what's going on. Of course, the news has just, I think, has caused a little bit of a kind of capitulation move.
Overnight gaps are where discipline gets tested and emotions take over. As Chris Vermeulen points out here, volatility can erase a month of gains in a single session, especially in miners and energy-linked trades. Oil's sudden move after muted futures action suggests positioning was complacent before headlines hit, a classic setup for capitulation spikes. When markets chatter, it often signals indecision beneath the surface, not strength. For investors balancing commodities and equities, this kind of whiplash demands tighter risk controls, not bigger bets. Next, Chris Vermeulen discusses whether oil's surge reflects trend change or emotional overshoot.
So when we zoom out, well, first let's look at the daily chart here of oil. We saw about 11 or 12% spike in oil in overnight trading with the news. That's initial wave of fear. Everything hits the media, and algos and traders instantly panic. And of course, they created a huge move. When we have war, we tend to see gold and oil move higher. And since then, we have been seeing oil kind of pull back quite a bit. It's given back about half of those gains since that news kind of broke free. Now, when we zoom out on the chart of oil and we just kind of go way back in time, you'll notice that the long-term moving average, is green 150-day moving average, which is a great gauge of what the long-term trend is doing, the markets really are still kind of making a series of kind of lower highs overall. The trend is down. This is a counter trend rally kind of within a bear market that oil has been in. And we've just had this big gap, more or less, on news just around it. Now, we kind of had a similar scenario over here in terms of bombs being dropped, and it created a huge spike. And so this is what happens in a bear market. You get some of the strongest rallies, and a lot of times they're triggered by some type of news event, and it creates anybody who's short to start to cover.
An 11 to 12% overnight spike feels dramatic, but context changes the story. As Chris Vermeulen points out here, oil remains below its long-term 150-day moving average, still printing lower highs in what technically qualifies as a broader downtrend. News-driven surges often trigger short covering, not sustainable institutional accumulation, and half the gain has already been retraced. That pattern, sharp gap, quick fade, has repeated in prior geopolitical shocks, especially during bear phases. For energy investors, distinguishing structural trend from headline reaction is critical. Next, Chris Vermeulen unravels whether this rally has real staying power or simply exhausts itself.
And of course, this is a big event, and it's created another huge pop in price. So the big question is this just a news-driven pop up into and past resistance, and is it going to fade back down? At this point, I kind of think that's what's going to happen, and I think we'll fall back down into this range. But when you look at it short-term wise, definitely a lot of people today are thinking oil's going to go through the roof. But this type of move is typically a capitulation move. We usually see exhaustion, big gaps, big news kind of hit when prices is pushing to an extreme. And we're seeing this today across the board. This has happened in gold and in the equities markets, which we'll touch on shortly. So at this point, oil is, it's the fear has been worked into it. It might want to rally back up, test those highs today or over the next couple of days. But I think it's going to be very similar. The news is going to fade away, and we'll see the fear kind of drop as well. Unless obviously a lot more bombs and more things kind of escalate, then oil will hold itself up here.
When price surges on fear, it often signals exhaustion, not strength. As Chris Vermeulen points out here, these sharp spikes into resistance after major geopolitical headlines tend to resemble capitulation rather than sustainable breakouts. Oil pushing past resistance while retail traders panic about shortages is classic late-stage momentum, especially when gold and equities show similar emotional bursts. Historically, gaps formed during extreme news events often retrace within days as liquidity normalizes and fear premiums unwind. For investors, chasing here risks buying volatility at the top of a sentiment cycle. Next, Chris Vermeulen discusses how this pattern has played out across other asset classes.
So I was reading oil commentary by some oil analysts. Eric Nuttall was commenting on social media. He's a well-followed oil analyst. He said, typically this, you're right, Chris, this will be a fade the news kind of event. And I'm paraphrasing here because I don't have the exact quote in front of me. This will be a fade the news kind of event for oil. But things are escalating as we speak. And so it doesn't look like things are calming down anytime soon. We're at the beginning phases of this conflict. And, how would you factor that into account?
Yeah, I mean, no one really knows how that's going to fizzle out. Maybe, this could just be escalating. This could just be getting started and could ramp up. But the news magnifies, amplifies everything, right? I got some messages from people who don't really follow the markets, and they're all in a panic. Oil's going through the roof, gold's taking off, all of this stuff, and they feel like they're getting left behind.
When casual investors start texting about oil shortages, sentiment is already overheated. As Chris Vermeulen points out here, even respected analysts admit most geopolitical spikes fade, yet the media amplifies worst-case scenarios because fear drives clicks and volume. The real risk isn't escalation alone, it's emotional positioning, where inexperienced money chases commodities after a vertical move. Historically, early conflict headlines create exaggerated pricing before supply data or OPEC policy even adjusts. The gap between narrative and fundamentals is where portfolios get damaged. Next, Chris Vermeulen unravels why panic participation is often the final ingredient in a short-term top.
And that's usually, usually a sign that this is more of a capitulation move. So we just have to let time and let price figure itself out. You can't just throw everything out and think that a one-day move on news is going to change anything at this point.
Okay. Just looking at this chart, this big gap up, what would you typically do in a situation like this? We've encountered this many, many times before, you and I, with silver, with gold, with mining stocks, with Bitcoin, with individual stocks within the NASDAQ. This is not a new pattern for us in our audience. So what are you doing now with this information?
Yeah, typically when you have a big move, when we zoom out here, when you have a big move above a resistance level, this falling kind of trend line, we have this huge gap. So gaps generally get filled, meaning if a gap's really high, it's usually going to fade back down. As you mentioned, you fade the gap. It's a trade that a lot of people do, aggressive short-term traders. And so when you have a big gap, first of all, they usually fade back down once the momentum stalls.
One-day explosions rarely rewrite long-term trends. As Chris Vermeulen points out here, these gap-ups above resistance have appeared repeatedly in silver, gold, Bitcoin, and NASDAQ names, and most eventually retrace once momentum cools. The uncomfortable truth investors ignore is that gaps act like magnets. Price often revisits them because liquidity wasn't built there. Throwing out a strategy over a single headline-driven candle is how disciplined portfolios become reactive ones. Patience protects capital when volatility spikes. Next, Chris Vermeulen talks about how to position when gaps above resistance start losing momentum.
We also not only have a huge gap, but it actually gapped above resistance. And it also happened on very big extreme news over the weekend where people can start to panic and build up stories in their head and start to worry. And it creates these huge moves. So typically when you see a big move that happens on news, we tend to expect that market to fade back down to where it was before all of that. So these are usually a short-term trade or a short-term blip on the chart. If the long-term trend is down, this is just one of the spikes, one of those blips that is just volatility within the asset class where news and things like that just trigger these sharp pops and drops in the market.
Weekend headlines create Monday morning mispricing. As Chris Vermeulen points out here, a gap above resistance driven by extreme news often reflects emotional repricing rather than structural change in trend. When the broader trend remains down, these vertical spikes are typically volatility bursts inside a larger decline, not the start of a new bull phase. Investors who mistake noise for direction end up overtrading in choppy markets where whipsaws erode returns. The real edge is recognizing when fear has already been priced in.